What's going on, guys? It's Arkham. Welcome back to another video, and I'm glad that you're here because in this video we're going to be detailing a really good model that I've personally been hiding, but I want to share with you guys for free here on YouTube. This model and how I teach it helps you guys focus on how to create a daily bias and make it simple, how to anticipate precise entries, as how to catch the daily range. So not only am I teaching you how to create a simple, easy, and repeatable daily bias, but I'm also giving you guys the step-by-step checklist that you can use to create a high probability entry, plus how to scale in and use proper risk management to maximize on your winning trades. Towards the end of this video, I'm going to give you guys the exact trading plan as well as a free gift. So make sure you guys watch the entire video and soak up all the value. And if you guys haven't already, make sure you guys are following me on Instagram at Arkhamtrades. Now, with that all out the way, let's get into the video. When we think of a price leg, there is generally two phases, and the first phase is the original manipulation. So we can see here we have this depiction where we see this opening price and then price sees this rally higher. This is then formed as our manipulation, and then the other is our distribution. So we come higher, create this manipulation, and then we see this drop lower for this distribution. And we can see the same happening right here where we open up, come lower for a manipulation phase, and then we see this rally higher for an overall distribution. If you're anticipating the marketplace to go lower, you have to be in alignment with the manipulation, meaning as price is going higher, you have to be actively looking to short, and as price is going lower, you have to be actively looking to go long. You want to buy as the marketplace is going lower and sell as the marketplace is going higher. You don't want to be in a situation to where you're chasing the markets higher or chasing the markets lower. You want to be in a position to where you're already anticipating the marketplace to do what you want it to do. And you guys may be asking this very simple question: well, Arkham, how do I know price is not just going to continue going lower or continue going higher? And when can I anticipate this? Well, this brings us into our next lesson. So we can simplify this by incorporating two things, right? The first thing we're going to incorporate is the candlestick anatomy theory, where one higher time frame candle is developed from lower time frame movements. So as you can see, we have this 4-hour candlestick, and this 4-hour candlestick is derived from lower time frame 15-minute structure. So we have this opening price, we come lower in a market maker sell model. Price then establishes a low and then goes into a market maker buy model, reaching higher prices for that daily range. This is then the candlestick anatomy theory, and this is not only just for the 4-hour time frame, but we can use this with the daily time frame. So if this was a daily candle, we would look at the 1-hour structure, 4-hour 15-minute structure, 1-hour 5-minute structure. So the higher time frame candle is derived from lower time frame structure. So if we're anticipating price to go higher based off of a bias that there's structure down here and there's support down here, well, you want to be buying below this 4-hour candlestick opening price. Or if you're looking at the daily candlestick, you want to buy below that daily opening price, right? You want to be buying at the opportunity to where it'll give you the best entry. And the best entry is from the opening and below it, meaning that you're buying as the marketplace is going lower to get that solid entry. And then once price comes back higher into the opening price, you then get that confirmation that you have established a low here, reaching higher and higher prices. But you also may be asking another question. Well, Arkham, sir, now that I know I should be buying below the higher time frame candlestick low, how can I frame an entry? Well, let's get into our next and final lesson. How we can frame our entry is based off of two things: a higher time frame point of interest plus a turtle soup. Let me explain. Well, in this depiction, you can see price has a substantial move to the downside. Clear as day, price is going lower, leaving multiple inefficiencies inside the marketplace. Let's say this is a fair value gap or an order block, just keeping things simple using just 2 PD arrays. Right, we have this imbalance. Price has been making lower and lower prices, and price is coming back higher to now fill in this imbalance. Right, structure from the higher time frame is already indicating that we're in an overall sell model. You can either take the longs down here at these lows to reach back into this imbalance level. This is called external to internal. Right, coming down here, we tap into external liquidity, reaching back into internal liquidity, which is inefficiencies, right? Inefficiencies are usually referred to as internal liquidity. So we have an external to internal setup reaching back higher prices, and then we have this internal to external setup where we see price come higher, tap into this fair value gap level or this order block, whatever inefficiency you want to use, as well as it takes out a prominent area of liquidity, right? We have this previous high here, which is then referred to as our turtle soup, right? This is a level of liquidity that is near a area of inefficiency. This is a high probability setup because not only do we have this inefficiency, but we also have this area of liquidity, plus the overall trend of the marketplace has been seeking lower and lower prices. So if we're framing a perfect setup and a perfect opportunity to get some of the highest probability moves, this would be it. We're above the opening price of this higher time frame candlestick. We took out a level of liquidity, plus we tapped into a higher time frame point of interest. Check, check, check. Those are 3 checklists that you can use to frame a bias and frame a narrative inside the marketplace. Very, very simple, right? Daily bias doesn't have to be something very complex. It can be something as simple as just a simple checklist. And what you can do also, because you may also have another question, well, Arkham, well, where do I put my stop loss? Well, what you can do here and how I use my trade management system is I would enter my initial trade with a lower risk but a higher stop loss. Just in case price may see a rally higher than expected, I have that added cushion. And then once I get that confirmation, like I mentioned, that confirmation, I will then scale into my trade idea. We have this rally back higher in this market maker buy model to reach into a level of internal liquidity. We enter our initial setup with a low risk but a higher stop size to take into account because we are selling as the marketplace is going higher. So we use a low risk but higher stop size. And then as we get that additional confirmation, we can then scale into our trade ideas and adjust our stop loss into the previous high, because once price gives us this confirmation, this previous high on the higher time frame candle is now our strong high, and price should not refer back to that previous high. Instead, it should see this massive push to the downside, reaching down into the daily range, right? Just trying to keep things as simple as possible for you guys and having it in a step-by-step checklist so you guys can properly understand the markets and hopefully go into your charts and backtest this and implement it into your own trading. Towards the end of this video, I'm going to give you guys the exact trading plan plus a free gift, so make sure you guys continue watching and stay tuned. And if you guys are getting value from this video, make sure you guys click that like and subscribe if you haven't already. And if you guys want to, you guys can click the first link in the description and join Spark Trade University. Inside Spark, we have over 30+ hours worth of lessons top to bottom. We have daily live education with all of our students going over the markets and trading live. Plus, we have weekly progress calls with all of our students to make sure they're on the right track. No other mentor is putting as much effort into their students and making sure their students are finding similar results as me and my brother Spec Trades have. And that's why we've created Spark Trade University. And if you guys go through Spark Trade University for 1 year and you guys don't see any results, me and my brother Spec Trades will personally coach you one-on-one until you see some type of consistent profitability. We want to give you guys the blueprint and the roadmap that me and my brother Spec Trades use that helped us become profitable in the next 6 to 12 months. And if you're someone who's serious about putting in the work, being dedicated into trading, and hopefully becoming a full-time trader and turning this into a career, join Spark Trade University today. But if you're someone who's lazy, who doesn't want to put in the work, who half-asses, then don't join Spark Trade University, because this is not the place for you. This is a community of elite traders looking to become the best version of themselves and master these markets the best that they can. So if that's something you guys are interested in, that's the first link in the description. And now back to the video. So we're looking at our first example here on US 30, and we're looking at the 4-hour time frame. And from this time frame, we want to identify our overall structure inside the marketplace, plus identify any higher time frame points of interest. Following coming into this bearish value gap or level of inefficiency, we saw this drop to the downside. This is signaling to us that the higher time frame order flow is bearish, and most likely price is going to respect bearish levels of resistance and potentially see a continuation lower. And what we can identify here is this imbalance here in the form of this 4-hour bearish fair value gap, just like so. So we have a clear area of inefficiency above us, plus we have an area of liquidity as well. What is this? This is the prior daily high. So we have this area of inefficiency, plus we have this area of liquidity. You guys are seeing the overall market structure. You guys are framing your areas of resistance. Now what you guys want to do is you guys want to exercise patience, wait for the marketplace to come to you, and then execute. We're going to go down to a 15 minutes time frame and get more context. So we're down on the 15 minutes time frame, and as we can see, price has this prior daily high, as well as we have that 4-hour bearish fair value gap. What I want to see here is I want to see price open up, right, continue higher, reaching back up into this level of imbalance, to then see a drop to the downside, reaching back below areas of liquidity. So right here we have the 4-hour time frame. We had this opening price, we saw this drop lower, looks like it dropped lower into this bullish order block, and then we saw this push to the upside, creating this bullish momentum higher. Internal liquidity, right, tapping into this bullish order block, now reaching back up into internal liquidity. So an internal to internal setup. Now I'm anticipating an internal to external setup, where we came up higher, tapped into this area of inefficiency to then reach back lower into external areas of liquidity. So I'm going to put my limit order here around the 50% of this H4 bearish fair value gap. So as the marketplace is going higher, I'm shorting it as it's going higher, because I anticipate this to be a level where the marketplace cannot break. I'm going to have a higher stop loss back above the high of this 4-hour fair value gap, reaching back below areas of liquidity for over a 5-to-1 R. What I really like about this model and how I trade it is this offers you some of the best RRR setups, because not only are you getting a great entry inside of a higher time frame point of interest, but you're also targeting that daily range, seeking external levels of liquidity. You're essentially catching the tops and you're selling at the bottom, right? It's almost perfect in a sense. So we're gonna see how the next 4-hour candlestick opens here, and as long as we're selling above the next 4-hour candlestick opening, this is a high probability setup. Let's see what happens. So we can see price just sees a massive wick to the upside, tapping into the 50% of that H4 fair value gap perfectly. And as you can see, price just immediately sees this run to the downside. So this trade ran all the way down here for over a 5-to-1 R. And when we're talking about confirmations and when you guys should be scaling in, the best scaling opportunities are at inversion fair value gaps or order blocks. So seeing how price gave this bearish engulfing candlestick right here, breaking back below this last up close candle, and we had this next candlestick opening, this would have been your opportunity to scale in based off of price opening up, reaching back up into this last up close candle. You guys could have gone a nice scale in opportunity and adjusted your stop loss back above this previous high right here, adjusting your stop loss lower, reaching back below those lower lows perfectly, right? So when you guys are scaling in, order blocks or inversion fair value gaps are a really good reversal signature that price has then confirmed, and you guys can use those as frames of entry. Now let's get into our next example, which we're looking at gold. I know that's one of y'all favorites. So on the next example here, we're looking at XAU USD on the 4-hour time frame for October 2nd. And one thing when it comes to gold is you never ever want to be that person that fights the trend. Don't fight the trend with gold. If gold wants to go higher, it's going to continue going higher. If it wants to go lower, it's going to continue going lower. So always be the person that trades along with the trend, right? I know a lot of gold traders right now that are only taking longs because the market is just higher probability to go higher than lower at the moment. The first thing we want to look at is the higher time frame market structure and the higher time frame trend. We're clearly supporting bullish price action, right? Supporting bullish price action for over a month now, or 2 months, however much, supporting bullish price action, continuing higher and higher. So our overall narrative or overall bias, we're seeing this drop lower here to induce traders, right? To essentially fake traders, right? Traders see this drop and think, oh, the market's gonna crash, this is the top. But no, is simply coming down here to induce those traders to then gather that liquidity to then continue the market higher. So we can identify this previous point, right, as a level of liquidity. So this would be our previous daily lows, right? The previous daily low right here, this is Wednesday 9 a.m. and currently we're at Thursday 5 a.m. Plus below that we have this order block level, just like so, right? You can name this like supply and demand, right? Whatever, right? This is a level of support inside the marketplace, plus we're taking out a level of liquidity. So this would then be a high probability setup. So if we could see the marketplace come down here, take out this level of liquidity, plus tap into this order block level, we could then see higher prices reaching back above external points of liquidity, right? This is an internal to external type of trade. So I'm going to go down to 15 minutes time frame here and wait for the next 4-hour candlestick open to then frame my bias. So we're looking on gold here on the 15 minutes time frame, and we can clearly identify that turtle soup, which is back below this previous low right here. This area of liquidity plus this area of liquidity, plus we have that 4-hour order block level. So as price is coming lower, right, as price is coming lower to take out these levels of liquidity, I want to then be going long, and I want to have a wide stop loss below this order block level. And if we can get that confirmation, I'd be more than glad to scale into my position, reaching back up higher prices for over a 3-to-1 R. Right, it's very important that when you guys are buying below previous lows or selling above previous highs, there has to be some type of narrative and context behind it, right? The context behind this is we're in a level of demand down here, and I'm anticipating price to find support to then reach back higher prices. Plus, if price comes down here, we would then be buying below this 4-hour candlestick opening price, would offer the best opportunity to get a precise entry, catching that 4-hour expansion to the upside, reaching back above external points of liquidity for at least a 3-to-1 R. Plus, we also have that scale and opportunity to maximize on our trade. So this gives us pinpoint multiple references to where we can maximize on our winning positions, as well as we lose a lot less, because if price comes lower and stops us out, it only stops us out with a very low risk. But when it goes in our favor, we could then scale in aggressively, making 3-to-1 R, 4-to-1 R on our setups, establishing not only great technical analysis, getting a precise entry, but you're also getting a great risk reward. Let's see how this plays out. And as you can see, price comes lower below that opening price, taps into that order block level just like so, plus takes out this level of liquidity. Perfect setup. Plus we get this massive rejection higher, and we have these last 2 down close candles as order blocks to then scale in. So if price can come back down into this last down close candle opening price, I'd like to scale into my position. This would then adjust my entry to about down here. So my new entry would be about down here to take into account the entry down here plus the entry up here. So my new entry would be right here. So I went from having a wider stop loss to now adjusting my stop loss as I get that confirmation and that break of structure. I can bring this original entry back to break even, and this new entry right here will have a tighter stop loss. You're not only getting a great entry, but you're also maximizing on your winning positions. Let's see how this plays. Like we mentioned, price comes down into this order block level. When it comes to scaling in, when you scale in, your entry goes higher. So since we enter down here and we entered our position right here at this order block, our new entry is 50% between up here and down here. So this would then be our new entry, reaching back above higher prices. Just like that, price comes all the way back higher up into these highs for over a 3-to-1 R. Plus we had that additional scaling, which maximizes on our winning potential. So that's going to be it for a video. I hope you guys got a lot of value from this video. And if you guys want the full step-by-step trading plan, that's going to be a link in the description. You guys can copy and paste it into your notes app or write it down in your journals. Right, as well as if you guys want access to my free course plus my free ebook, that's also going to be linked in the description, as well as a free trading community that I made specifically for you guys, as well as I will mention any discounts or promotional codes for Smart Trading University or my Patreon in there as well. So that's gonna be it for the video. I hope you guys got a lot of value from this video. Make sure you guys click that like button, subscribe, comment what you guys want to see next, and share this with another trained friend, so hopefully they find my channel and see some type of success. I'm Arkham. Be safe, guys.